Hi friends, I'm Penny, here to give you my 2 cents about saving for college. Today we've got a special request from Jan in Norfolk, Nebraska. Dear Penny, I'm a new parent and we're looking into starting a Nest 529 account for our son. There are all these terms like qualified expenses and tax advantaged, and I feel a little lost. Can you get me up to speed on all the 529 lingo? Ooh, vocab was always my favorite subject. Let's get started with the ones that you asked about. Qualified expenses are educational expenses that you can use your Nest $529 to cover. Things like tuition, fees, and books are all qualified expenses that you typically won't have to pay taxes on when you withdraw your funds. You can find more info on this at nest529.com/use of funds. Those qualified expenses are seen as required for enrollment at an eligible school. Most accredited schools, including universities, community colleges, trade and vocational schools, and graduate schools, fall under this category, meaning you can use your Nest 529 funds nationwide. Nest 529 accounts are tax advantaged, which is another super fun term. That means while your contributions grow over time, any earnings won't be taxed while the funds are in the plan. Some states, like Nebraska, also offer tax deductions for Nest 529 contributions made by account owners. You might also hear us throw around the term investment options. When you open a Nest 529 account, you can choose between our age-based, static, and individual fund portfolio investment options that invest in funds from Vanguard, T. Rowe Price, DFA, and others. Last, but certainly not least, we'll cover the person you're saving for, the beneficiary. This is the person who the 529 funds are meant for. It could be a loved one or even yourself. Thanks for that great question, Jan. I hope this was as helpful for you as it was fun for me. That's all for this episode. And remember to send your own questions to Penny at nest529.com. This is Penny, signing off and reminding you to save early so your loved ones can soar. See ya.
An investor should consider the investment objectives, risks, and charges and expenses associated with municipal fund securities before investing. This and other important information is contained in the fund prospectuses and the Nest Direct College Savings Plan Program Disclosure Statement, issuer's official statement, which can be obtained at nest529.com and should be read carefully before investing. You can lose money by investing in an investment option. Each of the investment options involves investment risks, which are described in the Program Disclosure Statement. An investor should consider before investing whether the investor's or beneficiary's home state offers any state tax or other state benefits, such as financial aid, scholarship funds, and protection from creditors that are only available for investments in such state's 529 plan. Investors should consult their tax advisor, attorney, and/or other advisor regarding their specific legal, investment, or tax situation. Account owners are eligible to receive a Nebraska state income tax deduction of up to a maximum of $10,000, $5,000 if married filing separately, for contributions they make to their own Nest accounts. Contributions in excess of $10,000 cannot be carried over to a future year. For a minor-owned or UTMA 529 account, the minor is considered the account owner for Nebraska state income tax deduction purposes. The minor must file a Nebraska tax return for the year their contributions are made to be eligible for a tax deduction for their own contributions. In the case of a UTMA 529 account, contributions by the parent or guardian listed as the custodian on the UTMA plan account are also eligible for a Nebraska state tax deduction. Withdrawals used to pay for qualified higher education expenses are free from federal and Nebraska state income tax. Qualified higher education expenses include tuition, fees, books, supplies, and equipment required for enrollment or attendance. Certain room and board expenses incurred by students who are enrolled at least half-time. The purchase of computer or peripheral equipment, computer software, or internet access and related services, if used primarily by the beneficiary during any of the years the beneficiary is enrolled at an eligible educational institution. Certain expenses for special needs services needed by a special needs beneficiary, apprenticeship program expenses, and payment of principal or interest on any qualified education loan of the beneficiary or a sibling of the beneficiary up to an aggregate lifetime limit of $10,000 per individual. However, earnings on all other types of withdrawals are generally subject to federal and Nebraska state income taxes and an additional 10% federal tax. Nebraska law does not treat K-12 tuition expenses as a Nebraska qualified expense. If a withdrawal is made for such purposes, although it is a federal qualified withdrawal, it will be treated as a Nebraska non-qualified withdrawal and may result in the recapture of a previously claimed Nebraska state income tax deduction, and the earnings portion will be subject to Nebraska state income tax. Please consult your tax professional about your particular situation.